Good morning, Richard Calhoun, real estate broker with Creekside Realty, 40 years working with buyers and sellers in Silicon Valley. We're here to talk about Silicon Valley real estate market, week number 12. We'll come back to this slide in a few minutes. The first data slide is showing supply and demand. The reason there's three lines is there's two supply lines. The first supply line is the blue line down at the bottom. That's total available inventory. We're comparing it to the 5-year median, which is the yellow line. So if all three lines were on the yellow line, then we would be having a typically normal year. What's a typically normal year defined as? The median of the 5 years just before COVID, 2015 through 2019, which were 5 good years. If we were on the yellow line, we'd be having a good year. Where do we stand up? Inventory is down around 65%. So there's less inventory. That usually speaks for shortages, increased prices. Then what you look over to is the other type of available listings, and that's the gray line. That's the number of new listings that came on the marketplace. And you can see that's been right above the 5-year median, maybe 105, 110%, but slightly above. If you've had more inventory coming on the market every single week and you have very little inventory, how do you explain that? You flip over to the demand side, the red line, and you can see that the demand has been about 110, 115% above the 5-year median. If you have demand above where it should be or where it typically is, and you have inventory only slightly above where it should be, you end up with inventory shortages, and that's where we're at today. Now we're looking at the raw data. We're looking at days of unsold inventory. This is the single biggest indicator, in my opinion. It's how long would it take to sell the existing inventory for the existing rate of sale. Again, the yellow line is the raw count, the raw DUI for the 5-year median, 15 through 19. The blue line is the current data. With DUI, the lower the number, the faster the marketplace is, because this says that we basically sell everything out in 14 days on the marketplace, and that's a fairly fast marketplace. The 5-year median was also a fast marketplace, but it was more up here around 22 days. So we're basically a third faster than we were in the 5-year median. The vertical purple line is the split between 2000 and 2020 and 2021. So in 2021, you do have to subtract off 1, which is why there's 53 weeks. It's really 52, but to get the horizontal spacing. Now we're looking at what the buyers are feeling. This is how much pressure the buyers are feeling when they're making their offers. Historically, my worst month ever was December 2001, and that is monthly data. And my best month ever was April 2018. We're clearly now exceeding that for quite a bit of time, and I've sort of made this executive decision. What I'm going to do is on about April the 6th, I'll go back and get data for March, which is March 1st through April the 4th, and I'll come up with a new best monthly data line and start plotting that. But you can see the solid lines for the most recent 8 weeks, and they're all basically at or above the best month, with the exception of the brown line, which was the oldest, which is all the way back to February the 5th. And if you think about it, on February the 5th, escrows that closed the week before that, that brings you back to like January 28th. Then if you take a normal 30-day escrow, you're having negotiations back in 2021, definitely before the New Year's or right at the New Year's. So it did not have the 2022 appreciation. These lines up here are almost all, or especially the later lines, are almost all offers that were negotiated and accepted in 2022. So they do have the 2022 appreciation in there if you subscribe to my belief that it's basically a step function. In reality, it's a very rapid ramp up, and then there's a little bit of overshoot, which is probably the marketplace we're in right now, before it corrects and comes back to the level that we're at currently. So prices will probably go up a little bit more, come back down, but you never know what's going to happen. That's the normal pattern. But again, the big takeaway is your last 7 out of your last 8 weeks have been really solid. The 8th week back was still a very strong, one of the better weeks we had. Then the dashed lines are the next most recent, and then the dotted lines are the oldest out of this group. Moving on to the same data, but just less of it so you can see it better. You can see now we have basically 7 of the lines up here, both solid and dash, because there's only 4 of each. So 4 solid lines, 3 dash lines. Again, the February 2nd line is dashed down here, and then you have your 4 dotted lines. So you can see there was a real jump with escrows that started closing the week beginning February the 3rd. Now, this is a little recap of the key indicators of the different types of properties. So Santa Clara County single family, you can see it's got a huge shortage of only 56%. San Mateo County's doing better or closer to normal at 88%. And your condo markets are over the level of inventory you'd expect. Then you flip down to offers accepted. With that, you can get DUI, the rate of sales. So you're at 13.9 days for Santa Clara County. San Mateo County is actually a slightly hotter marketplace despite a higher percentage of inventory expected at 13.6. Is there a difference between 13.6 and 13.9? No. There is a difference between 20 and 13, but not between 13.6 and 13.9. Not that anyone could perceive. It's, even statistical fluctuation could make the difference on that. And surprisingly, the condos are moving relatively quickly, even though they have normal level of inventory. Then when you finally get to the delay of sale price, you can look at the frequency and magnitude of overbidding. So 92% of the home sellers of single family homes in Santa Clara County got more than their asking price, 90% in Santa Mateo County. And that does not include those that got their asking price, which, is not going to be a large percentage when 92 or above, but it might be somewhere in the ballpark of 4%. So that means only 4% of the sellers are getting below their asking price in Santa Clara County, for example. And those are just estimates. I do have the number, I just don't have them in front of me. You go down to condos, 89% in Santa Clara County are getting over asking price and 82% in San Mateo County. Magnitude of overbidding, these are also record numbers. 118% of their asking price in Santa Clara County on average, 116% in San Mateo. Condos are not getting overbid as much, but still very respectable at 11% and 7% over the asking price. Appreciation, that's pretty significant. Now, remember, my base is the whole entire 2020 calendar year. So any escrow that closed in 2020, the median of all those prices is what I'm looking at. The peak appreciation for 2021 was 25%, and that happened on June 29th of 2021. The peak appreciation for San Mateo County wasn't until December the 4th. Condos were basically the month of August, and you can see they were all fairly significant. Now you flip over to this past week. So we're now only looking at 1 week. And so you're looking at closer to 2 years of appreciation, not quite, because we're still in March. So you're looking at the transactions for the last 5 weeks, I'm pretty confident. And you have 38.7% appreciation, almost 40% appreciation over what it would have sold for in 2020. And that's the whole calendar year 2020. The peak price on that was probably May timeframe. The median escrow was the first week in August. Median calendar month is July. So we're not quite for 2 years. And the reason it's a little convoluted is most people use the same period for their base and their current measurement. I specifically didn't want to do that because by doing that, your base changes as well as your current value each time you're reporting the data. And so you don't get any numbers. So I wanted to throw an anchor in it. So I threw a stable anchor being the 2021 calendar year. Now, someone could go and say between June 29th and now, there's been 14% appreciation based on the price back in 2020. So you'd have to take 25% of that off. So your appreciation is somewhere around 11% if I'm doing my math anywhere close. So 11% appreciation in under a year is pretty significant. 24% appreciation in a little over a year is also pretty significant. So that's the kind of rapid appreciation we've been experiencing. With that, we'll go over the URLs. The green URL right here is what I call my root URL. That takes you to my YouTube archives. If you want any specific episode, you just put in the year 2022, the 2-digit month code 03, and the date 026, I believe, for the 26th. To get to the live presentations, you just put in the year 2022. For the handout we just posted, you put in H and the 8-digit year code. I'll pause for a second to see if anyone has a question for me. Moving on to not hearing any questions. This is a breakdown of the micro market areas. This is looking at the 3 key components. And the reason I'm saying 3 is, to me, sale price really isn't a key component, but is what most people follow. So I've thrown that in as a 4th column. So now what you're looking at is DUI, which is to me the single most important indicator. And you go from 41 days, which is close to a balanced marketplace. 40 to 80 is what I consider to be balanced. So this would still, it is in the balanced marketplace territory, but it's favoring the sellers at 40, only, 2 days over. At 60, you start favoring the buyer. From 40 to 60, you're still favoring the seller for a little bit. To really get into a buyer's marketplace, you have to get up around 85 days of unsold inventory. And you can see none of the micro market areas are anywhere close to that. There's no area that really stands out. There's a lot of stuff here right at 11, 13 days. You got 17 days, which is a little bit high for Cupertino, Sunnyvale. Los Altos, 21. The expensive areas in San Mateo County is the highest at 41. South County, I sometimes point out, is at 16, so it's pretty robust. Foster City, Redwood Shores is at 32. That's a very small micro market area, so it's probably just a timing issue because it normally is a very aggressive marketplace. And then your condos down here are doing fairly well. And you don't see this very often. In Redwood City, 100% of the sellers got more than their asking price. And I am actively working in that area right now, and I can share that the median overbidding was 111%. Here, the average is 17% above the asking price. It's a pretty aggressive marketplace. You got 96.7 for the moderate areas, which are Campbell, Cambrian, Santa Clara, Willow Glen, 95, 92, 89. So you can see they're just all over the place. Down here, 94%. So 100%, you can't get 100.1%. Can't get more listings selling above their asking price than their asking price. So that you can't beat that record. You can tie it, but you can't beat it. And it's the first time I think I've seen it. Actually, I guess for Cupertino, I think saw it for, no, it saw 98 or something. I think it was one listing short. This might be the first time we've seen 100% in a micro market area. And then the magnitude of overbidding. This is the average overbidding. I did that intentionally because the median would often, in a halfway normal marketplace, would be 100% and we wouldn't gain anything. I go saturated red at, I think, 117.5%. So a lot of these are the same color, even though there's quite a bit of variation. 120, 121, 122. 117.9 for the whole county, 111 for San Mateo County. Then you go over to the sold price that everybody tries to follow. The middle number is the median, which is what most people follow. The number to the left is the lowest 10 percentile for that area, the 10 percentile pricing. Median is the 50 percentile pricing. And then the top percentile pricing is 90 percentile. A lot of statisticians look at quartiles. That would be 25, 50, and 75 percentile. I actually made a conscious decision to spread it out because when working with clients, saying 50% of the homes are between these two numbers really isn't that impressive. But when I can say that in the moderate priced areas of Santa Clara County, 80% of the homes are going to sell for between 2.1 and 3.6 million, the consumer can realize quickly whether they're in that price range or they're not in that price range. The other thing I wanted to point out, because it's sort of nice, is Redwood City is almost always the median price. And so that's white. And then you go a little bit below $100,000 below, and you can start seeing the color coming in. So you go from 2.66 to 2.56, and you can start seeing a little bit of blue. And even at 2.5, you can see a little bit of blue. And then on the other direction, going up a little bit in price, you can see some red come in Cupertino, Sunnyvale at 2.8 million. And that's basically the concept here. The redder the color, the more expensive. The bluer the color, the cheaper. The white color is the median for the area. And then for condos, because the prices are below the single family homes and because there's not as many micro market areas, I assign the white color to the maximum price, and then I go down from there. And I do have one minor correction that I will have to get to, and that is the affordable areas, South San Jose, Central San Jose, and East San Jose used to be the most affordable, and now it's North San Mateo County. So I need to change my base to get those two to be the right shades of blue, but they're all right. It's just there's two that are saturated blue instead of only one. Now looking at the number of new listings coming on the market. So you can see there is some fluctuation. You can see last week was a fairly robust week for new listings coming on the market. This week we're back down to 100%, but you can see that last year, and I'm not sure what causes this dip, but the dip was there last year. It's just weekly fluctuations that happen. It might be Martin Luther King's birthday, but I wouldn't think that would be that significant to impact the data that much. And that's March 31st. So it's this coming week. So I would have expected the drop of inventory to show up this week, not last week. So I'm not sure why that happened, but maybe someone else out there knows. This is total inventory. inventory, and this is macro data. So this is Santa Clara County, San Mateo County, condos and townhouses all blended together. The yellow line is where we'd expect the data to be based on the 5-year median. And you can see last year we were there. Last year we actually started the year above, got down to normal expected inventory. And then because of the surplus demand, we fell further and further below, and we're starting off below and not gaining any ground. I wouldn't say we're losing any ground, but we're definitely not gaining any ground. So we only have somewhere around 1,025, 1,050, probably closer to 1,050 homes on the marketplace when we should have 1,500. So you're about 450 listings short, or about a third. And that's why I think the number was somewhere around 69%. This is looking at the number of new offers. And you can see, there's fluctuations here. This right now is mostly corresponding to the number of new listings that came on the market. Remember, there was a drop and then an increased number of new offers. And here the number of offers follows suit. The real takeaway, though, is here's where you'd expect inventory to be, the yellow line, the 5-year median, and yet you're up here on the blue line way above the 5-year median. This is looking at days of unsold inventory over time. We're going all the way back to the beginning of 2020. You can see the huge slowdown for COVID. You can see the slowdown at Christmas time, New Year's every year. And then I jump out now in increments because I was having issues where some weeks this wasn't getting updated. Now I can tell if it gets updated. So clearly we're up to date here on March 26th. Their data's flat to going down. San Mateo County is going down fairly rapidly, but there was a hump. So, it's a slope down. Santa Clara County is a little bit better behaved in a slope down. Condos and townhouses appear to be a slope down. I will point out it jumped up, but again, that's some statistical fluctuation. For every week we meet, there's 7 data points. I do this every single day, and that's why there's some jags in this line. And there's also occasional bad data point. When you see a big spike like this, that's clearly a bad data point. I clear up the ones that are really visually obnoxious, but I leave the other ones just because it takes time. And eventually my goal is to go in and go back to my raw data and try to find out where the error is and correct it and have smoother lines. The jaggedness won't go away, but the jumps will. This is the map of your days of unsold inventory. Again, the redder the color, the hotter the market, bluer the color, the slower the marketplace. There is not blue. The closest to blue we have is white here at 41.8. And I'm pretty sure at 41.8, that actually has a hint of, it does have a hint of red. At 42.5 is where I go completely white. So I'm not sensing it, but I can sort of see a square box. So maybe there is a little bit of pink there, but it's very faint because you're so close to where it's going to be completely white. Here's looking at the frequency of overbidding each week. On the left-hand side, you have 2022. So you can see where frequency of overbidding is now up 90%. Again, macro data. Last year at this time, we were only down around 75%. We did get up to 80%. It almost looks like the 80% we were at last year is going to be replaced by a new normal 90% this year, which is insanity. But that's what it looks like we're doing. This marketplace is clearly hotter than last year. It's no rational explanation, but no rational explanation for why COVID didn't slow down the real estate marketplace, other than high tech, is having its, time in the limelight. We're relying on high tech to present this presentation. The whole world has changed yet once again in my lifetime, many times it seems like. Here's the frequency of overbidding for the different counties: Santa Clara County in the red, San Mateo County in the brown, and then condos and townhouses in Santa Clara County in the yellow. You can see all of them are going up. Santa Clara County looks like you could say that it rolled over and went flat. San Mateo County looks like it's going flat. Condos looks like it's still going up. Frankly, it's hard to get above 90%. Frankly, it's hard to get above 80%. So the fact that these numbers are going up is pretty strong indication of how strong the demand is. And it's all demand driven right now. Here's the overbidding broken down, same concept. And I won't even talk about white or blue because there isn't any. So the redder the color, the hotter the marketplace is. And the coloring starts at 50 and goes saturated red at 95. So Campbell's saturated red, Milpitas is saturated red, North San Mateo County is very close to saturated red. Then there's other areas that are close. San Mateo, Redwood City's got its 100%. It's saturated red. The lowest percentage of overbidding I'm seeing on here, I guess, is the 73%. So I'm doing that live with you. So the San Mateo County coast over here has got the lightest shade of pink, lighter even than the expensive areas on the San Mateo County border with Santa Clara. Here's the magnitude of overbidding over time. You can see that we're record high territories. I believe, well, macro data I don't have. I believe it was something like 112 and 114% for Santa Clara and San Mateo County historically back in, I guess it would have been 2005. So these are above all-time record highs at 16%. And that's macro data. The single family homes, if I remember correctly, is up to 17%, 117% of asking price. It is 117% of asking prices. It's 17% above asking price. Here's the overbidding magnitude over time. You can see San Mateo County has rolled over. Whether this is a trend or just will stabilize, I would depend more on stabilizing, but look how rapid San Mateo County went up. Santa Clara County clearly started going up about last Halloween, I think that is. And then when we hit New Year's, the slope of the increase was dramatic. Condos was pretty flat until the first year. San Mateo County actually lagged behind. You know, it was probably the end of January before it jumped, but it turned around and caught right up with Santa Clara County, not to be left behind. Here's the magnitude of overbidding. Again, there is no white and there's no blue on this graph. Once you get above 101.5, it goes to red. The lowest number I'm seeing is the expensive areas at 100, essentially 108%. You're saturated red at 17% over, 17.5% over. I've already moved these colors intensities once because I figured going somewhere around 10% was safe since my record high was 12. You don't mind getting saturated occasionally, but you don't want your whole map to be saturated. But I'm going to resist moving them because we're not that far over 120% versus 117.5%. And the more stable your data is and your benchmarks, the easier it is to compare, which is part of the reason I got into this is benchmarks were changing all the time. So I really resist changing my benchmarks. Here's just the median price. And this is your three components. So Santa Clara County single family homes, San Mateo County single family homes, and Santa Clara County single family homes. So you can see all have gone up in price. And here is how you could get year over year average. It'd be hard to do, but you pick whatever month we're in now, and then you go back exactly a year and you compare them. But, you know, with the fluctuations, you know, if you're down here or up here, is that really depreciation or is that a change of what's being sold? Because, you know, take Redwood City, for example, if all of a sudden more homes are being sold east on the base side of El Camino Real, the median price for Redwood City is going to drop versus if more homes start selling on the west side, the hillside of El Camino Real, the median price is going to increase, and it has nothing to do with property values. And that's one of the reasons you do micro market areas. But even, you know, Redwood City is one of my micro market areas. So within Redwood City, there's quite a bit of different ranges. And that's why you do a CMA when you're really trying to determine market value. This is to give you an overview of what the market's doing when you're trying to get an overview. When there's too much data coming at you is when you look at statistics. Now you look at the price geographically. We already talked about the middle being the median. The number on the left is the lowest 10 percentile or the 10 percentile, 50 percentile, and 90 percentile number. The Redwood City up here in San Mateo County is white because that's the median. You can see Mountain View, Cupertino is going to be a little bit pink. Saratoga, Las Gatas, pinker. The pinker the color, the higher the price. The bluer the color, the lower the price compared to the median. Here's the appreciation of each micro market area. Notice how most of the micro market areas are hitting their record high. In the moderate priced area, it's been stable for 3 weeks, but I consistently go for the first week it hit that price. Basically, everything is over to the left-hand side, which says that prices are increasing. The furthest back is the expensive area that has a lot of fluctuation because the houses are so different and it's a fairly small micro market area. You know, you had 39.2% appreciation just a few weeks ago, and now you're down to 21%. Does that mean home prices fell 18%? No, it means what sold is 18% lower. You have to look at apples and apples to determine what's happening with property value. I think Redwood City, I mentioned earlier, is the highest appreciation at 54% appreciation, and that's over the 2022 base year pricing. Here is looking at March data, and those that have followed me long enough know that you can't have March data when you're not past April the 5th. What do I do for March 2022? I take last night at midnight and I go back 35 days. So granted, I'm not comparing apples and apples, but it's the closest I can do a comparison to and sort of be somewhat forward looking. So obviously we're at a record high price. Median days on the market is a record low. Come down and you got the square footage. Really no change. There's quite a bit of fluctuation. The house is actually a little bit smaller. So if you have a record high price with a smaller house, that would tend to indicate that prices are up higher, more up than the price indicates. But you also have to remember this is what's on the marketplace and it's what's not selling. So it tends to be a little bit high, but not always. If the low end of the market's selling quicker, the list price on currently available is going to be higher. If for whatever reason, and it has happened a couple times, where the high end is moving really rapidly and the low end's slow, then the reverse is going to happen because the low end would stay on the market lower, pulling down the median price. And that's why there's very little data for what's on the marketplace. It really doesn't tell you much. So now let's jump down to offer. This starts becoming significant. And here you basically are tied for 2020, 11 and 7 days on the marketplace. Very difficult to get below 7 days for half the property selling that quickly because most of the clients and most of the agents are willing to expose the property for a weekend. And by the time you put it on the market, expose it for a weekend, look at offers and report it to the MLS, you're basically at a week. Yes, you could probably do it in 5 days. 5 to 8 to 9 days would be fairly common. Some areas like to put their listings on the market on Monday. So they're going to be more like the 10 or 12 day range. DUI is not impacted by that in sort of a more objective standard. And you're at 14, and that is a record low. Basically, even though the days on market that most consumers are following are tied with 2020, because your DUI is significantly faster at 14 days than 40, there's no question this is a better year. Compare it to last year, 16 to 14. It's a small numerical difference, but since it's so hard to get down below about 10 days, that is a significant improvement in the marketplace. So this is significantly hotter. Median list price, we don't know the sale price of offers accepted, 1.7 million, 34 homes selling per day. Let's compare this for a second. You go back to 2020, we were only selling 19 homes a day, but yet we had up here 773 homes on the marketplace. And people were saying the reason we weren't selling more homes was the lack of inventory. Now we have 2/3 the inventory, 475, and we're selling 50%, 70% more of the homes than we were back here, 75% more homes with less inventory. So the limiting factor was not lack of inventory. Now at 475, you might actually be able to make a fairly strong argument that the activity, the number of offers accepted, is being limited by what's available. And I would actually sort of support that. You just have a DUI of 14, you have days on market of 7. When you have more inventory coming on the market this week, for example, if it happens this coming week, the week after that, you have more sales. I would finally say that we are probably limiting sales. We were not doing it back when we had 775 sales, and there's not better documentation, in my opinion, than this example to show that. Then what the typical home is, 1,786 square feet, that's basically right where the median square footage of these homes have been. So the median for single family homes in Santa Clara County, which is all that's in this table, this is not macro data, has been fairly constant. Magnitude of overbidding at 18% over, 118% of asking price. Frequency of overbidding, 92%. So you can see these are both significantly higher than they were just last year, which was the best, hottest year we had until this year. Median price, it keeps on going up. We're now at 1.9, almost 2 million, $1,900,000 for the median price for single family homes in Santa Clara County. The asking price was only 1.6. So on the typical hot property got 300,000 over their asking price. And that's almost 20%, which is basically what we're at, 18%. Number of closings, 890. So we're outperforming 2 years ago and 3 years ago. We're not outperforming last year we still have another 10 days to get up to that level. And because we have an end of the month coming up, we might get to that 1062. If you look at it, it looks unsurmountable right now, but there's a fair chance that we'll get there. And then the typical home. And then the last table for this week is the same data, but now I'm comparing apples and apples. But because of that, I have to go back to February data. So this is data from February 1st coming forward for 35 days, which I believe is through March the 7th, getting the data on March the 8th. So I'm not going to go into this in details. And that brings us back to the URLs that we've talked about. And so I will pause and see if anyone's got a question for me. And if I don't, I'll wrap it up and wish everybody a nice week. Not seeing any questions. Have a nice week, everybody. Take care. Bye for now.